Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thanks for joining me for this month's market update. Markets extended their rally this month with both the S&P 500 and Nasdaq reaching new highs as investors remain focused on strong corporate earnings, continued momentum in AI-related spending, and a resilient US economy that continues to absorb pressure from both higher energy prices and interest rates. At the index level, we're seeing a continuation of last month's moves, and the markets have continued to look very strong. The S&P 500 spiked to 7,500 earlier this month, but underneath the surface, we're seeing a more selective environment. After a shift towards more defensive sectors earlier this year, leadership has narrowed again, with technology, semiconductors, and AI infrastructure companies back, driving a disproportionate share of returns, while more rate-sensitive and consumer-oriented areas of the market have generally lagged. Once again, this is much more of a CapEx-driven market right now than a consumer one. That divergence has been particularly visible within semiconductors. Over the last several years, semiconductor companies have increasingly become the infrastructure layer behind this global AI buildout. While much of the AI-driven returns have gone to the tech giants, semiconductor stocks have come to the forefront now, particularly over the last 6 weeks or so, as shown here by the SOX index, which has more than doubled during that time period. Investors are rewarding these companies most directly tied to computing power, networking capacity, and overall AI capex. They're not the only area benefiting, but the sheer scale of this run has stood out. Many of these semi companies have seen their revenues spike as demand seems insatiable right now. And that has helped make their valuation metrics seem plausible despite such a strong rally. But the risk from here is whether that revenue and earnings growth is actually sustainable going forward. That brings us to earnings season, which has once again been a key support for markets. Overall, earnings results have remained constructive, especially within tech and energy. And with that, this rally in equities from the March lows has continued to be supported by actual earnings growth and upward revisions, not simply expanding valuations. We saw that from NVIDIA's results this week, which were once again closely watched by investors, not just because of the company itself, but because the stock has become a proxy for broader AI demand and the willingness of hyperscalers to keep investing aggressively in infrastructure. And once again, NVIDIA had a blowout quarter. But the stock actually sold off slightly after the announcement despite those results, highlighting just how high expectations have become for this stock. But when you look at the space overall, it was a strong signal that so far, that CapEx spending trend remains intact. At the same time, investors are becoming a bit more selective. At times during this AI cycle, markets have rewarded nearly any company associated with the theme. Today, the focus seems to be shifting more towards execution, margins, and whether companies can translate AI investment into durable earnings growth. That's one reason why we continue to see a narrower group of companies leading index performance. While equities have staged a strong comeback, the bond market has told a somewhat different story over the last several months. While we don't typically focus on 30-year bonds, it's worth noting the long bond reached levels this month not seen since before the 2008 financial crisis. Treasury yields across the curve have moved higher as investors reassess the outlook for inflation, fiscal deficits, and the path of Federal Reserve policy. At the start of the year, recall that markets had fairly strong conviction that multiple Fed rate cuts would happen in 2026. Today, that confidence has faded, and in some cases, markets have even begun pricing in the possibility of rate hikes if inflation remains on this path. This is more than just a short-term Fed story. Investors are now demanding higher yields for long-duration capital. That's reflecting uncertainty around inflation and borrowing needs from the US government over the longer term. Speaking of inflation, this month's data continued to show the economic damage being done from the conflict in Iran, with CPI jumping to 3.8% year over year from 3.3% last month and just a 2.3% rate of inflation a year ago. And while higher energy prices are maybe to be expected given the circumstances, services inflation also remains sticky, and markets are beginning to question whether monetary policy is truly restrictive enough to bring inflation back toward the Fed's long-term target. With Treasury yields running meaningfully higher than the Fed funds rate, it's now a real possibility that we see the Fed have to hike rates in the second half of this year if we don't get some relief on the inflation front. Finally, I wanted to spend a few minutes discussing energy markets, which remain a critical variable to watch as we move through the summer months. It's no secret that oil prices have weighed on investors, and concerns around global energy stockpiles and spare capacity continue to mount. From a relative standpoint, the price of Brent crude is still below the spike we saw during Russia's initial invasion of Ukraine. And while the conflict with Iran remains open-ended, market participants are convinced that the U.S. is focused on finding an off-ramp as soon as possible. And in the meantime, the United States remains better positioned than many international economies because of domestic production and overall energy independence. And on the other side, Europe and many emerging markets remain more vulnerable to these higher energy costs. And we're seeing that reflected in some of the equity market moves across the globe. Energy also matters well beyond gas prices. Sustained increases in oil prices can influence inflation expectations, shipping and packaging costs, manufacturing input costs, and ultimately, central bank policy expectations as well. As we look ahead over the next month, investors will continue to focus on economic data around inflation and labor markets, but as energy stockpiles continue to take a hit, we should expect things to come to a head with Iran sooner than later. Hopefully, with a peaceful resolution that opens the Strait of Hormuz and brings some sense of normalcy back to energy markets. For now, markets remain supported by strong earnings and AI-related investment, but are navigating a more complex backdrop that's shaped by higher rates, inflation, and energy dynamics that should not be overlooked. We're here to navigate through this period alongside you. Thanks again for joining me, and as always, please reach out to your advisor at RWA with any questions. We'll see you back here for our update next month.